Good afternoon, ladies and gentlemen. I'm Theo Chambers from Shore Financial. Here today with me, I have Dom from CRIBZ. He's our property expert or property guru, you could say. We thought we'd bring Dom in just to talk about the current property market because it's been, all over the media recently. We had a great run in the property market for a couple of years, and now we had one of the biggest sort of corrections we've seen in, I think, about 20 years, followed by one of the biggest rebounds last month. In 2.5 years for a monthly rebound. Dom, what are you seeing out there? Give us your words of wisdom. We've had 3 rate cuts now, 3 cuts to the cash rate, which is, I think we haven't seen that many in such a short period of time since 2012. What's your feeling on how this is going to affect the property market?
Well, there's been a number of different things that have actually affected the market over the past 6 months. We had the election, which changed things. We had all the results from, brokers and banks were getting smashed a little while back, but that's kind of finally eased up and you can actually lend some money.
Yeah.
And I think that we've already seen some of the market kick as a result of the 2 rate cuts, but this third one is going to yet to really kick in. What we've seen in the property market largely is for the past couple of years, there hasn't been a lot of stock that's come onto the market. Year on year, it's been about 30% less than the previous at the height of the market, which means there's not a lot of property out there. And I think people that are buying property are probably feeling that. And that's also evident when you have a look at clearance rates. So clearance rates, for all those that don't really understand what that means, it's the percentage chance that a property is going to sell in the market at the auctions. So for instance, for the past couple of months, it's been about 70, 80%, particularly in Sydney and Melbourne. The other markets operate a little bit differently, but 80% chance that if you were to bring your market out to your property onto the market, put it up for auction, it's going to sell. That's really, really good. And what that's meaning is a big competitive pressure. And we're seeing some of that upswing, particularly in spring. And I think if you have a look at Sydney, Melbourne, it's been about a 4% rise over the past month or so. And it's really been top of the market driven. So the higher priced properties, if you're going to split the property market into 3 sections, a lower priced, middle and higher priced properties, it's been the higher priced properties that's really led the market growth over the past couple of months in particular.
So clearance rates in relation to stock levels, right? You just made a comment then that, there is a low stock out there. But, I've heard rumours through all our real estate partners, there's a lot more stock coming to the market. How do you feel that's going to change things if there's more stock? Do you think there's that depth of buyers there? Look, I personally think in our business, we see a huge depth of buyers out there of people wanting to buy a property. They just can't find the right property. The question is, if there's all of a sudden double the amount of stock on the market, how does that affect things?
Well, that's when we start seeing the bounces, right? We've seen it come back, and it probably will go back the other way, but maybe a bit of a lull. And it also it's hard to talk generally because even within Sydney, there's a number of different markets. So the inner west, the eastern suburbs, the northern suburbs, they perform very, very well because they're tightly held markets and there isn't a lot of stock. But when, as you say, if there is an influx of property coming into the market, then that's going to just be a smorgasbord for buyers. That means there's going to be a lot more choice, a lot less competitive tension, and that'll probably have effect on the clearance rates. So, I'd like to say that the market would soften or ease, but with the interest rates dropping so much and then being the lowest ever, is that correct?
Record lows.
Record lows. There's a lot of buyers that are now doing some number crunching and say, hey, now I can afford my own home. A lot of first home buyers are being incentivized to come back into the market. And as you well know, the first home buyer isn't your stereotypical 21-year-old.
No, it's about 39, 40.
Yeah, that's exactly right. So they've been saving, they've got good deposits. A lot of my clients are seeing big deposits and waiting for this discount, which the market currently is, and they're stepping back in. So there's only further incentives for more people to push into the market. And I think that for the next 6 to 12 months, it should be quite positive outside of any crazy black swan events,
Yeah, look, we're definitely seeing that, to your point, the different markets, there's markets within markets, and every market is acting so differently, right? Some markets, the ones I think close to the city, 10, 15K radius to the CBD, in every market year on year for 2 years, it's been 30-40% less stock, and I don't see that changing drastically, especially with low rates, right? Because a landlord that's got a property tenanted right now, it's even more appealing for them to hang on to the property because their yield's just increasing, providing that the rent doesn't decrease. But I don't see that happening anytime soon either. For that to happen, we probably have to see more investors come to the market, buy properties, and put them all to market to rent. And we're not probably seeing enough investors come to market that they probably should. Are you seeing the same thing? Is there probably a lack of investors coming back? There should be some more to come.
Well, I think we discussed it earlier. I think there's two types of investors. There's the more sophisticated investors that are looking at things outside of just property market numbers, yield, potential growth rates, what my rent is going to be, depreciation, all that kind of stuff. They're looking at bigger macroeconomic factors and seeing what the economy is doing. Low inflation, low participation rates, so we're not really full employment. There's a number of factors from an economic scale that says that the economy isn't great, and they're even looking at grander things like what's happened in the US and whatever else. Globally. But I think for the average punter, your first-time investors or the person buying your second or third investment where you're kind of stepping into the market, you've seen a little bit of growth, you've got some cash saved up, now is a really good time to go back out there and invest. And I think they're going to come and jump into the market, particularly if you have a look at your cost to hold, right? With interest rates being so low, if you're able to go and get an investment that's yielding 4%, arguably you're near neutral, right? Or positive if it's in your property.
Well, I think investors are going to come back in full force soon because with rates being so low, they're not getting good yield on term deposits or cash, invested in a savings account. Share markets globally, the US is at record highs and, arguably set to come off in the next 12 or 24 months. The ASX has hit all-time highs recently as well. First time we've actually recovered to where we were pre-GFC just recently. That's 10 years to recover. So it's tough for an investor to put their money in those sort of investment classes when yield might be debatable, especially if you've got to factor in maybe a bit of a capital loss with shares coming backwards. It's quite safe to say that a good investment property within say 15 to 20 kilometre radius to the city would get 4% gross yield.
Yeah, that's exactly right. I think that's kind of what you're after. If you're looking at blue chip areas and you're staying within a certain price point, if you're going to go spend $2 or $3 million on a property, you're probably not going to get those kinds of yields. Might be 1.5%. But if you're spending, less than $1 million and closer to sort of 750, that's that sweet spot for a higher yielding property. I think the lower price you're spending, the higher the yield's going to be. And if you're buying in growth corridors or higher quality areas that aren't CBD, you're going to get some really strong yield, just because if you have a look at a rental perspective, the lower the price of property is, the larger the market is. So the closer to median would become, if it's between $550 and say $800 rent per week, there's a lot of people that can afford that. So, if the lower price properties, you're going to see a higher yield.
Look, I did have some questions listed here, but we're jumping all over the place. And on that point, it's a great question to ask. I think in the last 5 years, something that's really changed is what is the typical property a tenant is looking for, right? And to that point, that $850 to $950 rental spot, years ago you would have said a 2-bedder with parking is the most common property that these tenants are looking for. But I feel in the last year or two, all our real estate partners are saying that the 1-bedroom apartment is pretty much just as easy to rent, if not more popular, because you're getting, for the same price per week to rent it, you're getting a much better apartment in terms of living room and kitchen and maybe a brand new development as opposed to an old 2-bedder that needs a renovation. Would you say the same thing?
Absolutely. So if you have a look at way that the demographics have looked, we went from a suburban city, Sydney and Melbourne and Australia at large, to now an urbanised one where we're getting more dense and just culturally, it used to be sort of 3.4 people per household, and now it's going down to sort of 2.1, even 1.9. So you're seeing people are having less children. You're seeing people leave the house a lot earlier. People have higher incomes, are moving into the CBDs, and there's a lot more choice. So we had a lot of the stock that was built in or started construction in 2014, 2015, peak of the market, complete recently. So there's a lot of new good quality options as far as design, amenity, and then also just floor plate and outlook. So you're seeing good quality properties that are one bedrooms that feel like they're twos. Instead of the pokey little one bedroom in an old red brick that's everything's kind of compartmentalized. Big open floor plan makes you, it's a lot of breathability. They've got balconies and they're just much, much nicer properties. So to your comment, I think what your agents and your partners are saying is absolutely correct. With the advent of GoGet and being able to share your car and jump into, an Uber, it makes a lot more sense for you to go and rent a nicer property close to the city, jump into the different public transport or amenities and just have a high quality of life.
So speaking of that, in terms of things to look for, something that has definitely been, all over the media in the last couple of years is, these developments and, good developments, bad developments. There's obviously been more news about bad developments because there's no news like bad news to put all over the media. But, I still think there are some good developments out there, and there's definitely some good opportunities. There's some properties you can buy now, especially after being discounted, a great value. And from my point of view, if I was investing, what I like about a brand new property, I don't need to replace the water heater, or we're not going to be hit with special levies to put a new elevator in or anything like that. What would be your words of wisdom there in terms of looking for a good development to buy in? If you were to try and buy a one or a two better investment property, how do you identify a good development from a bad one?
Yeah, I think you're right. I mean, the squeaky wheel gets, lubricated, right? So the market has been crying out where there were a couple of bad developments, Mascot and Opal Towers and all bits and pieces where they weren't ideal. You can say that we still did deliver 300,000 plus properties over the past couple of years, and largely they're all okay. So a few bad opportunities has meant that the whole market's been softened in the brand new property space particularly, but it just meant there was a lot of new entrants that came to the market. People were taking some shortcuts. But to answer your question, I feel like the good guys have always been good. They've got a big, strong reputation. They don't discount their properties very, very often at all. They're very reasonable the way that they price it. They use the same trades, they use the same builders, and they've got higher quality control methods than even the governments regulate them. So just a little shout out to companies like, your Mirvacs and your Pace and Sekasui House and those bigger organizations that have built millions of homes. They've got a severe problem if they build something that's bad. Their whole business, they've got projects that are 10, 15 years long. If they've got a bad problem,
reputationally
risk, so they have to deliver. They can't just build a development in a shell company, wrap up that shell company, run away, and now suddenly it's Strata's issue. They've got their reputation. They've got a whole development to build. So some people are scared of building in those master plan communities, but in fact, there's a lot of security that comes from that because they're delivering a ready-made retail, commercial precinct, public transport, and infrastructure, as well as that they have to make good on every single property that comes into the market, and also raise the price of those properties throughout the duration of the developments.
Well, I think the bar's been raised on what these people want out of a development, right? Because for 10, 15 years, each new development needs to supersede the one prior and be better, and I think to our point earlier of first home buyers, no one actually knows this. I'll throw it at you a question. What would you guess the first home buyer age to be?
Well, I think I've heard you say, is it 38?
It is 39, so close. But most people think a first home buyer is around 30. The average age in New South Wales and Sydney is 39, and 40% of them are actually buying as a dual applicant, as a couple, de facto or married. So that person, all those individuals as a couple, they probably know more about what they want in terms of a property. They've been maybe living out of home for a good 10 years. They probably know, what they liked about previous properties they rented, what they didn't like.
Yeah.
They're more particular. Some of the things that we hear from our clients coming back in terms of, I didn't like the balcony, didn't have enough space to, set up a barbecue and chairs, and in that part of the town you need that because XYZ reasons. They're so particular with their living arrangements. Your point about supply and the amount of stock that's come onto or the amount of brand new properties that are being added onto the market. I did read something recently. I don't have the actual statistics and data here with me, but there's a clear supply issue actually coming to the market or coming to fruition, I should say, where the supply of new housing in Sydney in particular has been easing for some time, especially because the banks really tightened up funding on developments and developers. And yet the demand is drastically increasing, right? Yeah. Fundamentals of economics means that that's only going one way, right? You've got a shortage in supply and a jump in demand. Surely we're going to see some strong prices continue. I think a lot of people are thinking this is just a short-lived sort of boom cycle we're about to get back into off the back of low rates. But this housing sort of shortage that they're talking about will probably come to fruition in about 2 years, which is then going to see this cycle keep running straight into another maybe 5-year boom market, right?
Well, it's interesting you say that because our government's very conscious of that. They're very conscious of our migration levels and it's our population growth. It comes because we're a global city now. We're coming into our maturity, and where you can see that our government's very well aware of our population growth because we're one of the fastest growing nations in the developed world, and I use that term loosely. And it's because of all the migration. We've got fairly loose migration laws where if you've got a good education, you've got a good income, you want to bring money here, we say yes. So we take in a lot of the world's best into our country that are well-educated, have higher incomes. And the world looks at the Australian property market, or even our economy, as quite robust. We didn't get hit by the GFC. We've got a good, stable political system. We've got great healthcare, education system's good, clean air. And as far as you're saying, supply and demand, it's very difficult, particularly in Sydney, to even develop. So the supply side it's even harder in Sydney as opposed to some of the other states. And just back to the point about our government being very aware of our migration laws and people coming in, one, migration pumps our economy up. They know that we're going to have a lot of people coming in, and you can see because of the amount of money that they're spending in public infrastructure. All the rail networks, the light rail, the metro, all the upgrades to our roads, the M4, the M5 link road, the cross city tunnel, all that kind of stuff has come in to be able to handle the population growth. So what you're pointing to there is really a failing on the sort of the private side of things, where you're right, banks haven't been so loose with their purse strings and allowing developers to get their stuff out of the ground. You need 110% debt cover and you need so many pre-sales, and it's really difficult to develop. And the fact that the market has come back has meant that, and a lot of this negative press meant that new supply into the market over the next couple of years is severely short of where it should be. And there may be a perfect storm in the next couple of years. You're right.
Yeah, look, I think people get caught up with certain economic signals, and the real affluent sort of educated investor is looking at some things globally, like you said earlier, and in terms of the global economy, and maybe some other signals here like low wage growth just locally across Australia, and they're thinking, oh no, I might hold back and see how things are looking for another 12 or 24 months. But the fundamentals, one of the biggest drivers for property growth is population growth, and our population is I think, I think by 2050 we're expecting it to be double here in Sydney.
Yeah, that's right. It's almost double.
Yeah. So
Melbourne's a little bit bigger than us. They might pip us for the biggest city.
Yeah, that's right.
But you're absolutely right.
Yeah, and to your point, Melbourne and Brisbane and other markets, don't want to say anything negative about those markets, but you look at right in a core area of Melbourne, on the corner of Chapel Street and Toorak Road in South Yarra. They're building a 40-story building with a few hundred apartments at least, and you just can't go build a 40-story apartment block in those parts of Sydney. The equivalent would maybe be Surrey Hills. Yeah. And it's very hard to get a 40-story building into Surrey Hills anywhere.
Anywhere. And just for a little bit of detail, I'm sure that you're well aware of it. It's just in Sydney, it's very difficult. Our regulations, like our development control plans, are very, very tight. They say that your apartments have to be 50 square meters for a 1, 75 for a 2, and 90 plus for a 3. And then they even regulate the way the wind flows in and the light and how much solar access. And it's very, very difficult. The other states that aren't so heavily regulated, where they could do, that's where Melbourne got in trouble. They had a lot of smaller apartments. The same with Brisbane. They had a lot of smaller apartments. And that's probably why, maybe Brisbane has some issues. We're talking about that earlier, where it's been that state that people predicted to run for the past 5 years, and it's basically done a lot.
Yeah, no, we've definitely seen that. And yeah, on the Melbourne side, I've actually personally rented some of those smaller apartments in the CBD. They'll put a 2-bedroom apartment in 55, 60 square meters. You walk in through the front door and there's the kitchen, there's the bathroom, and there's the toilet. It's all right there.
It's Japanese.
Yeah. Then you've got a car elevator as well, as opposed to a ramp for the car park, because they couldn't physically fit the ramp in the footprint of the building. It would have taken up too much of the land size for the car parking lot. And then makes queues to try and get in and out. It's crazy what's going on down there.
Yeah, regulations are a lot tighter here.
Yeah. And the quality, I feel, is better here because, well, that just goes down to the price. I think the developer can put more money into the development knowing that they're going to get a higher price per unit.
That's exactly right. And I think that you just see, because it's so hard to develop, supply and demand dictates that, you're going to get a better quality property. They can spend a bit more time in design, and they can demand a premium for that property. And people are now even implementing different sort of greener practices in their buildings because it's what the market wants. So we've got a private industry that does kind of keep their ear to the ground. They're paying attention and making sure they're delivering what people are asking for. So we are kind of blessed here. We've got a really good sort of well-established property market, particularly in, in Sydney, and we're obviously biased, hey?
Yeah, well, no, look, without naming names here or disclosing any of our confidential information as a business, we've got some very high-end clients in our business that operate globally on an investor sort of scale in terms of looking at property markets globally to buy in. And I was having a conversation recently with one of them who says globally Sydney is one of the most promising places to invest because not only is our lending heavily regulated and easy to regulate because, at one point there was 80% of our loans funded just through the 4 major banks. Now that's dropped down to 60%, but still that's quite easy to regulate. Whereas other markets, there's, in America, there's thousands of banks. And the transacting of property in America is far different to here. It's a lot harder to transact on property over there.
Yep.
A lot harder to rent out your property. You've got multiple people involved. Normally the person who finds a tenant for you is different to the person who manages the tenant for you, which just is kind of strange to me.
Even state by state laws and taxes and then even the UK, you've got different calling off periods.
And you know what? The big one that was all over the news recently, negative gearing. So in America, it's the other way around. Your home is tax deductible, and then you have to pay for interest on investment properties net after tax.
Odd.
Quite odd. Don't quote me on that. That might have changed recently, but that's the last time I looked at that was the play.
Yeah.
All right. Well, look, to wrap things up, that all sounds quite promising. Multiple sort of signals in the economy. Cash rate, record lows, 0.75 worth of cuts in the last 5 months. APRA loosening lending, making lending easier. And the federal election now out of the way. That was 6 months ago, but still, that's already still taking effect. I think buying property and the property market in itself is looking a lot more buoyant, a lot more promising. We're probably going to try and touch base with all our clients. Our call to action is to try and make sure our clients are aware of these opportunities that you're talking about. A lot of them probably don't even realize that buying an investment property probably affordable for them, right? They probably don't realize they don't need to come up with the cash. They've probably got the equity in their home and they could buy an investment property just by borrowing against their home.
People don't know how cheap it is to own an investment property.
Yeah.
I shock them every single day.
Well, especially now with record low rates, right? We got so caught up in the federal election with that one particular point around negative gearing and capital gains tax. The thing is, right now, even if you borrow 100% of the cost plus stamp duty, call it 100% purchase price plus cost, it's a lot of the time it's not even negatively geared. There is no negative gearing benefit. It's actually positively geared, which is a good thing.
That's right.
I think people need to realize, don't chase negative gearing because it does mean it's costing you something. If you can buy a property that's positively geared, then you're winning from day dot. And there's a lot of that out there, especially with the stuff you're seeing. So yeah, look, we're going to reach out to our clients and hopefully we get you involved in some financial health checks with them and seeing those good investments for them.
Awesome. Thanks for inviting me on the show.
Perfect. Thanks for coming in, Dom.